where we have money and all that. So now let's say we have a trend like this. Let's say we have a trend like this. Let's say we have a trend like this. Now on this trend, you notice that price will always want to come and take out all this. Sometimes it's going to test all this and it's going to go up. So now all these swing points, that's why I said you need to understand market structure, are liquidity zones. All these swing points are liquidity zones. All these swing points are liquidity zones. You understand? And also to all these swing points are also liquidity zones. It's becoming confusing, Abby. Now when we talk about liquidity, we have the internal range liquidity, we have the external range liquidity, we have engineered liquidity, but that's much more. If you go into the advanced class, you're going to be hearing stuff like that, engineered liquidity and all that, right hand structure, left hand structure. Those ones are for the advanced class. If you are going deep into this, liquidity is quite big. So when we talk about that, we are talking about, for now we are going to be using engineered liquidity. What do we mean by engineered liquidity? These are liquidity points that, as the market is moving, either going up or going down, it creates swing points, either swing highs or swing lows, that attracts traders to want to take trades at that point. I think that would be the most basic example I can use. It's going to attract traders to want to take their trades at that particular zone, at that particular point, just like you're seeing here. Sometimes you see traders who take trades here and you take trades here, and market just going to come and take them out. You understand? Now you're seeing the way the market is coming to take out these liquidity zones, all these zones. Market is coming to take it out. Even this one too. You might just see the market going to do something like this to create another liquidity zone, and all of a sudden the market is just going to keep going up and just going to take all of them out. Now all these points you're seeing that looks like this, all these points you're seeing that is being taken out by this trade are liquidity points, because looking at it here at all these swing points, we have sellers at this point. There are people trying to sell this trade from those points, because we retail traders, we many times take our trade on zones like that. We tend to take our trades on those zones many of the time. So you are going to see us taking trades at those points like this. But then again, you might take the trade here and all of a sudden the market is going to take you out. You take it here, market is going to take you out. Now that's where I said all these are engineered liquidity points. Same thing goes in here, like this one, we have the internal range liquidity at this point and the market is taking it out. Understand? When I mean internal range liquidity, I'm talking about liquidity that's inside a particular structure. Inside a structure. Let's say as the market is going up, we have this inside a structure. You understand? Those are internal range liquidity. Understand? So now we have markets taking out by sellers here. The same thing goes here too. If it's an uptrend, if it's the market is going up too, you will notice the same thing. I'm just going to be using this example. I'm just going to be using that. So now let's go to the chart and see what I mean by what I'm saying when I say liquidity. As a trader, this is where most of the time traders have issues. Understand? That is why this is a master class, because you are going to just learn a lot, and if you know what you're doing here, you can actually use it to trade. So now when I say engineered liquidity, I'm talking about this. All these are engineered liquidity those things that we normally used to call higher lows, we are going to be calling them liquidity this time around. We are not just doing a normal beginners class. This is basically road to advanced class. So now, if you notice, the market took out all these liquidity points, taking out all these liquidity points, taking it, and it's just dropping down. Now that is how price moves. It's always coming for liquidity. It's always coming for liquidity. It's coming to always take out those zones, just like you're seeing here. It's coming to take out those zones. The same thing goes here. It wiped it off and it came down. There are people that are waiting for this trade to come here, just like the support. That's why I had to teach support and resistance first. They're waiting for this trade at this point, and they got stopped out. The market took out their SL. You understand? There are people also putting their trades here, and they got stopped out. Now, sometimes I'm going to, the best way for this sometimes is to go to the higher time frame. So go to the higher time frame, and when you've understood what market does, you're going to know that okay, the market is always coming for liquidity zones. Since it's always coming for liquidity zones, how do you tackle it? In trading, you have to be smart. If you are not smart, you cannot survive here a long time. Now look at this. Let's say we have a trend, the market is coming in this way, and all of a sudden you are going to see the market is going to take out liquidity at this downside. The next thing you are going to see, the market is going to go up back, go up, and it's going to now drop. Now, if you understood what I drew here, you know that you are seeing it already. Now, most of the time you see the market doing that kind of movement. So how do you tackle it? Now, you are seeing the market, this is a liquidity point, and as you can see, market went up, we tested into this swing, into this lower high, and market dropped, taking out liquidity on this point, taking out liquidity at this point, and all of a sudden we had another swing point here, and market took it out and immediately went to retest this zone. Immediately went to test this zone you are seeing here. This immediately went to retest this zone, just like you're seeing, and market started dropping. It happens almost every time in the market. Almost every time in the market. You can also see it here. We had this, and market took out this liquidity point and went up again, and we started having our drop in price, just like you're seeing here. Now the thing there is, sometimes you see some trades, what you should have in mind is, once you see the price moving in a particular way, let's say price has created a high and market is going, and all of a sudden you see price came to take out the low of that particular move and goes up. Once it takes out the low, it's always going for the high next. You just have in mind that once price has been moving and all of a sudden it takes out that POI, when I mean POI, I mean point of interest. So it takes out the low of that particular trend that was supposed to be mitigated. Oh god, when I mean mitigated, I mean tapped into before going up. Okay, let's say tapped into your support zone and it's supposed to go up, but instead it broke past the support zone and started going up. What you should have in mind is that market is going to go up to take out the liquidity above. You understand? So the market takes out that liquidity above. Have in mind that many of the time the market might do something like this, and it's going to go for this one, and it's going to come down. The same structure again. Are you seeing? It's almost the same structure. That is what is playing out here. Market moves in that manner. Market moves in that manner, and When it moves in that manner, you just have to be smart about it. But first of all, you need to understand market structure. If you don't understand market structure, it's going to be really difficult for you to understand what I'm saying. I'm just giving you a cheat code, and if you can study it well, you can use it to trade just with that little structure. It plays out all the time. Now, if it breaks below and comes down, sometimes it's going to go for what we call an order block. What do we call an order block? Order block is actually the last buy candle or the last sell candle before we have an aggressive move. Now, this is how an order block looks like this. This is what order blocks look like. So it's going to go straight to that point, and if you notice, that is where price, with all the examples I've been giving, that is where price is actually headed to. The order block, as you can see, is here. We have an order block here. The last buy candle before the drop in price, and you can see also too, I think there's another one there, I think there's another one here. You also have this one before we have this break in price, and price also went back to retest this one. It happens every time in the market. If you're just paying attention, you can just pay attention. The same thing goes here. You see, market was coming, and all of a sudden you had liquidity taken out at this point, and market still went back to this point to take out this order book. If you are confused about what I'm saying, you can ask me. Are you getting what I'm saying? Understand?
Yeah.
Okay, so you see, markets will always come, move in that manner. I'm actually just showing you that you guys that are here in the class, you guys will be lucky enough to understand what I'm saying. So the thing here is, once you notice price moving that way, once you notice price moving and starts creating higher highs and higher lows, just like you're seeing here. Once you notice price moving, always have in mind that price will always want to come and take out all this engineered liquidity. Price will always want to come and take out all those engineered liquidity. It's like a must for the market to always want to come and take out those engineered liquidity. Look at it, like this one, we had this here, and price was going, and you see price took out this, and all of a sudden, if you notice what happened here, price dropped, took out this liquidity that was supposed to even retest this one, and it took it out, and all of a sudden price dropped, and here again, I see. I still draw the zone for you, and it's had this drop in price. This drop in price that you're seeing that is small like this, this is almost, this is 377 pips. Okay, what is 377 pips? This is 3,704 pips. Technically, that is almost $300 and something if you are using 0.1. Understand? It might be looking little like that, but that is what you can make from just knowing how to go about that. You get? So liquidity is quite useful in the market. I don't like teaching for too long. I just like being practical about what I'm doing. So if you get it, you get it. If you don't get it, just have to watch it again, then till you get it. You understand? So that's how liquidity moves. Price moves in liquidity, always taking an order. Now you should understand that price is always looking for SL. Those SL, price is always looking for SL. Have you ever noticed that price, somebody is going to just, let's say somebody's enter a trade, somebody might enter a trade here. Someone enter a trade here, and all of a sudden, let's say enter the trade like this, and all of a sudden price will just come and wipe that person off. Now it's because of that person is actually trading it's because that person is actually trading inside that liquidity. is trading, so it has to be liquidated. The more the market takes out liquidity, the more money the market have. It's just like you're trading. As you're trading now, your brokers are looking for money, and the only way your brokers is going to make money are from this your losses. This is where the brokers they make their money from. The market make their money from this. If you are using a B book broker, we have a book broker. We also have a B book broker. We have different brokers, B book and A book broker. We also have C traders. So we have different aspects of it. Like the XNES are B book brokers. Things traders like the Deriv are the A book brokers. Most of the brokers you are using here to analyze your charts are A book brokers because they are correlated to the market. Like Deriv is in this. Many of the platforms you see here are A book brokers. Not as if the B book brokers are bad, but they are just there. But unlike the A book brokers, you'll be trading directly with the market. But the B book brokers, you are trading through them, and they are going to be giving you the market. But sometimes they can manipulate the market. Sometimes they can manipulate the market. What do I mean by that? Let's say this is not part of the class, but this is a master class. I'm just going to show you that. So even if you're using a B book broker, always look out for their spread and how their market spike in market. Let's say market is moving like this, and on an A book broker the market did something like this, and prices are going up. Now this same structure on the B book broker is going to look like this. Some of the B book brokers is going to look like this. Now if you are trading this on the A book broker, I seen the spike was quite little, but on the B book broker it might look like this. So that's why we have, I think I recommended a broker for someone in the group the other day, so that you can use brokers like that. The broker is okay. So this is how it looks like, but this is not what we are talking about. We're just talking about liquidity. Pairs like gold, BTC, Nasdaq, NAS 100, US 30, G40. We have what did I say? Synthetic. We have them to be liquidity. They create a lot of problems when it has to do with liquidity. The same thing goes here. You see it plays out all the time. Once the market has taken out a low, just have in mind that it's going to take out the high and it's going to come back to do the same thing I talked about. It's still here. It's always, it happens. It's something that happens in the market like every single time. Understand? The same thing goes there. You saw it and then you broke and you went back to retest this. Just the same structure playing out most of the time. There are other things involved, but if you can catch this, then you are good. I don't want to stay too long in the class. I don't like staying too long. I also have another class to handle. I have a podcast to engage in this evening. So I just wanted to give this piece, and I believe you guys understand it. If you have any question, you can ask me, so I can either shut down. Any confusion about this topic about liquidity? Any confusion? Any confusion about this topic or that has to do with trading entirely? Let's just fix it up and let's round up.